Imagine you just sold your business, right? For like 10 crores.
Yeah, a massive life-changing windfall.
Exactly. The money hits your bank account. And you walk into this top-tier financial institution expecting the absolute VIP treatment. I mean, leather chairs, espresso, maybe a metaphorical red
The
carpet.
whole 9 yards. You think you've made it.
Yeah. But instead, the financial regulator effectively hands you this massive, incredibly dense rule book and says, welcome to the deep end. The water is full of sharks. One wrong move and you lose it all. And those safety nets you grew up with, yeah, they no longer apply.
It is a profound shock for most newly minted high net worth individuals.
Right.
Because, they assume that having more money simply means having access to like better versions of the mutual funds or the savings accounts they already know.
Which is a platinum version of the same thing.
Exactly. But the reality of managing serious wealth in India involves stepping into an entirely parallel regulatory universe.
And today, we are looking at that literal rule book for that universe. We're dissecting the newly updated NISM Series XIA workbook.
Specifically the September 2025 version, right?
Right, the newest one. And our focus today is entirely on Chapter 7, which covers the role of portfolio managers. And I want to stress to you listening, this isn't theoretical economics.
No, not at all.
This is the operational manual published by the National Institute of Securities Markets, which is, an initiative of SEBI itself.
Yeah, it's straight from the regulator.
This document outlines the exact rules, the rigid structural responsibilities, and the extreme guardrails that dictate how big money is legally required to be managed in India.
It serves as the architectural blueprint, really, for the entire portfolio management services industry, or PMS, as it's known.
PMS, right?
If you want to know how the financial architects of the wealthy actually operate, how they're surveilled, and, the incredible lengths the system goes to protect that capital from external shocks or internal fraud,
It's all in here.
every single mechanism is codified right here.
Okay, let's unpack this, because I want to start with the foundational definition. People throw the term portfolio manager around constantly.
Oh, all the time.
Someone might have a really smart friend who gives them stock tips over dinner, or a broker who calls them with ideas, and they'll say, oh, yeah, that's my portfolio manager.
Right, it's used so loosely.
But reading this text, SEBI does not take that term lightly at all. There is a very specific, legally binding definition here that completely disqualifies that smart friend in a garage scenario.
The language is incredibly deliberate. Under the SEBI framework, a portfolio manager is defined strictly as a body corporate.
Body corporate.
Yes. This entity, pursuant to a highly formalized contract or arrangement with a client, advises, directs, or undertakes on behalf of the client the management or administration of a portfolio of securities or the client's funds.
That phrase, body corporate, jumps out immediately. Because they aren't saying, a qualified individual or just a registered professional.
Yeah.
They're demanding a corporate structure. So I assume that means you can't just be a sole proprietorship operating out of a co-working space, no matter how brilliant your trading algorithms are.
That is the core of the requirement, yeah. A sole proprietorship dies with the founder.
Right.
A partnership can dissolve over a personal dispute, but a body corporate implies institutional permanence.
It has to survive the people running it.
Exactly. It mandates a board of directors, independent oversight, registered capital, and, a level of auditable continuity.
Because the stakes are so high.
When an entity is managing hundreds of crores of other people's life savings, the regulator demands a structure that will still be standing, functioning, and legally accountable tomorrow, next month, and a decade from now.
Regardless of what happens to the star trader who sounded it.
Precisely.
So the barrier to entry isn't just intelligence or a good track record, it's capital and infrastructure. You need millions of rupees in paid-up capital, secure tech mainframes, certified compliance officers, just to get the SEBI registration to open your doors.
It's a massive undertaking.
But before we get deeper into the modern mechanics of how these corporate bodies operate today, we have to look back. Because there's a historical date in this workbook that I had to read it 3 times to make sure I wasn't hallucinating.
You're referring to the inception date of the SEBI Portfolio Managers Regulations?
Yes. January 1993.
It fundamentally alters how you view the regulatory priorities of the Indian market.
It completely blew my mind. Because, think about it, mutual funds are the ultimate mass market retail product, right?
Right.
They're designed to protect the everyday person saving for retirement or their kids' education. You would naturally assume the regulator would build the safety nets for the millions of retail investors first.
That would be the logical assumption.
But these incredibly complex regulations for elite, bespoke portfolio managers were actually put into place before the comprehensive mutual fund regulations were finalized.
Yeah, it's wild.
Why on earth did SEBI prioritize creating rules for the ultra-wealthy before sorting out the mutual fund landscape for the masses?
What's fascinating here is, if we look at the macroeconomic environment of India in the early 1990s, the logic becomes undeniable.
Okay, set the scene for me.
This was the dawn of India's market liberalization. The economy was unchaining itself from decades of the license raj. Foreign institutional investors were suddenly looking at India as this massive, untapped opportunity.
Right, but the market itself was...
It was notoriously opaque,
Right.
largely paper-based, highly susceptible to systemic shocks, and frankly, manipulation.
Yeah, the early 90s were the Wild West of the Bombay Stock Exchange. We had massive scandals, physical share certificates getting lost or literally forged, and brokers acting with almost zero oversight.
Exactly, and SEBI had just been granted statutory powers in 1992.
They were brand new.
They were, and they're looking at a market that was fundamentally broken in terms of institutional trust. They realized that for the capital markets to survive liberalization and actually grow, they needed the big, smart money to trust the plumbing of the system.
The foundation has to hold.
Right. High net worth capital, both domestic and foreign, is the foundational liquidity of a developing market. If a sovereign wealth fund or a massive Indian industrialist cannot find a safe, highly regulated, auditable framework for large-scale investment management,
They just take their money elsewhere.
they flee to offshore havens, or even worse, they fuel an unregulated shadow economy.
So securing the bespoke portfolio managers wasn't a matter of, like, favoring the rich over the poor.
Not at all.
It was a matter of securing the bedrock of the entire financial system so it didn't collapse.
Establishing those portfolio managers' regulations in 1993 was SEBI planting a massive flag in the ground. It signaled to the global financial community that India was establishing a secure professional class of fiduciaries for large capital.
Wow.
Once you secure the apex of the capital structure, and ensure that the biggest players are operating in broad daylight under strict audits, you can then methodically build out the retail mass market products like mutual funds.
That context changes everything. It frames the PMS industry not as this luxury add-on, but as the load-bearing pillar of market integrity.
Absolutely.
So let's fast forward to the modern market. We know these entities have to be heavily capitalized body corporates. But who are they in practice? If you have the capital and you're looking for these services, who is actually sitting on the other side of the table?
The source material delineates three major categories of providers operating in the Indian market today.
Okay,
The first group consists of the large brokerage firms.
makes sense.
These are the household names in finance. They already possess massive trading infrastructure, deep research desks, and vast networks of high net worth clients. It's just a natural evolution for them to extend their services from merely executing trades to actively managing portfolios for their top-tier clientele.
They already have the pipes, so they might as well manage the water flowing through them.
Exactly. The second category encompasses the asset management companies, or AMCs.
The mutual fund guys.
Right. These are the massive institutional whales that run the retail mutual funds. However, they recognize that their wealthiest clients require strategies more nuanced than a standard diversified mutual fund, so they operate entirely separate PMS divisions.
Yeah. And the third group.
The third are the boutique or independent asset managers.
Okay, the specialists.
Highly specialized, they're often tightly held firms whose entire corporate existence is dedicated to offering niche portfolio management. They don't have a retail brokerage arm, they don't run mass mutual funds.
They just do one thing really well.
Right. They might focus entirely on one specific strategy, like deeply undervalued small-cap manufacturing companies, and they cater exclusively to a select group of wealthy investors who believe in that specific thesis.
I want to pause here and really drill down on the mechanical difference between a mutual fund and a PMS. Because a lot of retail investors look at the wealth management industry and assume a PMS is just, a mutual fund with a higher minimum investment and a fancier brochure.
That is such a common misconception. But the structural difference is profound, and honestly, the traditional analogies often fail to capture the mechanics of asset ownership.
Right. The classic analogy you always hear is that a mutual fund is an off-the-rack suit, and a PMS is a bespoke suit from a master tailor.
Right.
And sure, that explains the customization aspect, but it completely fails to explain the ownership aspect, which is the most critical difference. Let's try a different mental model.
I'm intrigued. Let's hear it.
Let's compare traveling across the country. A mutual fund is like buying a ticket on a commercial airliner. The airline decides the destination, the departure time, and the route. You and 1,000 other passengers pool your money to fund the flight.
Okay.
When you get on board, you don't own the plane, you don't own your specific seat, you just own a fractional right to the journey. If the plane hits turbulence, everyone feels it equally. If the airline decides to change the route mid-flight, you have absolutely no say in the matter. You are entirely subjected to the collective experience.
That perfectly describes a pooled investment vehicle. The mutual fund AMC owns the underlying shares, and you merely own units representing a fraction of the total pool.
Right. But a PMS is chartering a private helicopter. You still hire a professional pilot, the portfolio manager, because obviously you don't know how to fly, but you dictate the exact coordinates. You tell them you want to fly low over the mountains or take a detour to the coast.
And then you can change your mind.
Exactly. And crucially, if you decide you want to land the helicopter and walk away, you can. Because in a PMS, the money doesn't go into a giant communal pot. The portfolio manager opens a specific depository account in your name.
Yes.
Every single share of stock they buy is legally registered to you.
Yeah.
You're buying units of a pool. You are directly owning a customized basket of individual businesses.
That is the defining characteristic. The direct ownership of the underlying securities provides an immense level of transparency. You can log into your DMAT account on any given Tuesday and see exactly how many shares of HDFC Bank or Reliance you hold. In a mutual fund, you only see the net asset value of the collective pool at the end of the day.
So we've established the entities, and we've established the direct ownership model. Now let's explore exactly how the investor and the pilot interact.
Okay.
Because Chapter 7 makes it very clear that this relationship is not monolithic. The regulations define 3 distinct flavors, or operational models, of portfolio management services. What is the first, and I assume the most prevalent, model?
The dominant model in the industry by far is discretionary portfolio management.
Discretionary.
Right. Under a discretionary contract, the portfolio manager is granted absolute independent authority to make all buy and sell decisions.
Total control.
The process starts with a deep consultation where the investor and the manager agree upon a broad investment approach. They might agree that the portfolio will only invest in the top 50 large-cap Indian equities with a focus on dividend yield. But once that sandbox is defined,
Once the boundaries are set,
and the contract is signed, the manager has total discretion within that sandbox.
they hold the steering wheel completely.
They do not call you to ask permission. If the manager's research indicates that a particular banking stock is undervalued at 10:15 a.m. on a Wednesday, they simply execute the trade on your behalf. They manage the entry, the sizing of the position, and the eventual exit entirely on their own judgment.
The client is just asleep in the backseat of the car, trusting the chauffeur to navigate the traffic.
Exactly.
Okay, so what happens in the second model?
The dynamic reverses entirely in non-discretionary portfolio management. Here, the portfolio manager continues to perform all the heavy lifting regarding market research, quantitative analysis, and monitoring the economic landscape.
They still do the hard work.
They still do the homework, yes. And they still handle the physical execution of the trades. However, they are legally prohibited from executing a single transaction without consulting the client and obtaining their explicit prior approval.
Wait, really? So they do all the homework, they identify the perfect opportunity, but then they have to stop and make a phone call.
Every single time. The manager will reach out and say, hey, our analysis suggests we should liquidate our position in company X and deploy the capital into company Y immediately due to a shift in commodity prices. But the manager's hands are tied till the client explicitly says, yes, execute the trade.
So the client retains absolute veto power over the what and the when?
Complete.
And the third flavor.
The third is advisory services. This is the most stripped-down model. The portfolio manager acts exclusively as a consultant. They analyze the client's existing holdings, they provide non-binding research reports, and suggest potential investment ideas.
But they don't trade.
They never touch the client's money, and they never interact with the exchange on the client's behalf.
They are purely an intelligence desk.
Exactly. The client takes the research, makes their own internal decision, and then uses their own separate brokerage accounts to physically place the trades.
Okay, I want to dig into the psychology and the practical friction of these models, because the non-discretionary setup fascinates me.
That's an interesting one.
If you are paying a massive premium fee to hire a world-class financial architect, why on earth would you insist on micromanaging them? It's like hiring a Michelin star chef and then standing in the kitchen telling them when to flip the steak. Seems fundamentally counterintuitive.
It does, but it reveals a lot about the mindset of individuals who generate massive wealth. The discretionary model is for the investor who recognizes their own limitations. They acknowledge they lack the time, the emotional detachment, or the specialized insight to actively trade.
They want the convenience.
But the non-discretionary model caters to a very specific psychological profile, often highly successful entrepreneurs or retired corporate titans.
Ah, people who built their empires by retaining absolute control.
Exactly the demographic. For someone who has spent 30 years making every final decision in their business, the prospect of handing over complete blind authority over their accumulated life savings to a third party is viscerally terrifying.
I can see that.
They desperately want the institutional-grade research and the sophisticated market analysis, but they refuse to relinquish the final lever of control.
But surely that control comes at a massive cost of performance. We know markets don't operate on a gentle schedule. If a geopolitical event breaks on a Friday afternoon, say a sudden embargo on a critical raw material, the portfolio manager knows instantly they need to dump a specific manufacturing stock.
Within seconds.
Right. In a discretionary model, they execute the sale in 3 seconds. But in a non-discretionary model, they have to call the client. What if the client is on a long-haul flight? What if they're at a board meeting and their phone is off?
You have isolated the exact systemic vulnerability of the non-discretionary model. Execution lag.
Execution lag.
The market is a brutal, hyper-efficient pricing mechanism. It does not pause to accommodate a client checking their voicemail. By the time the entrepreneur lands their plane, checks their phone, listens to the manager's urgent recommendation, and calls back to approve the trade, the stock price may have already plummeted by 15%.
The brilliance of the manager's research is completely neutralized by the client's physical unavailability.
Which is the primary reason why discretionary PMS constitutes the vast, overwhelming majority of assets under management in the industry today. The efficiency of execution is simply paramount. The friction of the non-discretionary model makes it incredibly difficult to generate alpha in fast-moving markets.
That makes total sense. Now, what about pure advisory? I'm trying to deduce who uses this. If I'm an Indian investor, it seems wildly inefficient to pay an advisor and then separately pay a broker to execute. Is this primarily designed for foreign entities?
Your deduction is spot on. Advisory is the go-to model for massive institutional clients, particularly foreign portfolio investors.
Okay, like who?
Picture a sovereign wealth fund based in Norway or a massive pension fund in Canada. They manage hundreds of billions of dollars globally. They already possess state-of-the-art global trading desks and prime brokerage relationships. They do not need an Indian firm to execute a trade for them.
They just need the local intelligence.
Exactly. They lack deep, granular, on-the-ground expertise regarding Indian mid-cap companies or localized regulatory shifts. So they hire an Indian boutique PMS firm purely in an advisory capacity.
So the Indian firm is just a radar.
The Indian firm acts as a localized radar system, feeding them high-conviction ideas and macroeconomic analysis. The European fund consumes that research, integrates it into their global risk models, and then executes the trades through their own massive global infrastructure. It's the outsourcing of localized intellectual property.
And just to close the loop on the categorizations, the workbook notes that beyond these 3 service types, discretionary, non-discretionary, advisory, the PMS, is also categorized by the actual underlying asset class. It's not just a stock market game.
No, the architecture is highly modular. While equity PMS is the most visible, catering to stock market investments, the industry is vast.
What else is there?
You have fixed income PMS, which meticulously builds portfolios of corporate bonds, government securities, and structured debt. You have commodity PMS. You even have mutual fund PMS, where the manager acts almost like a curator, building a bespoke portfolio comprised entirely of various mutual funds to achieve a specific asset allocation.
Oh, like a fund of funds, but personalized.
Exactly. And finally, multi-asset PMS, which dynamically reallocates capital between equities, debt, and perhaps gold, depending on where we are in the macroeconomic cycle.
So the investor chooses their preferred level of control, the service type, and then selects the financial terrain they want to conquer, the asset class. It's a matrix of possibility.
It is.
Now let's transition to the core of the regulatory framework. Section 3 in our outline focuses on the golden rules. We know who the managers are, and we know how the models work. But what are the absolute non-negotiable rules of the road they must follow once they actually have your capital?
The foundational cornerstone of the entire regulatory framework is established in a single phrase. The portfolio manager shall act in a fiduciary capacity with regard to the client's funds.
Fiduciary. That word is arguably the most important and perhaps the most abused word in the financial dictionary.
It really is.
But before we get into the mechanics of what that means, we have to address the massive elephant in the room regarding who is even allowed to ask for a fiduciary. Because the workbook dictates a brutal entry requirement. It says the portfolio manager shall not accept from the client funds or securities worth less than 50 lakh rupees.
50 lakhs is the hard regulatory floor.
I need to aggressively push back on this. 50 lakh rupees is half a crore. For the vast, overwhelming majority of the population, that is an inconceivable amount of liquid investment capital.
It is a huge sum.
Why does SEBI, a regulator tasked with protecting investors, build a massive financial wall around this industry? It feels inherently paternalistic, if not outright elitist. Why can't an ambitious young professional with, say, 5 lakhs access the same bespoke strategies, the same brilliant managers, and the same customized wealth generation that a billionaire gets?
It is the most common critique leveled at the regulator, but to understand the 50 lakh barrier, you have to disconnect emotion and look purely at mathematical risk capacity.
Okay.
SEBI is not acting as an elitist gatekeeper. They are acting as a structural engineer calculating stress loads. The key lies in understanding the immense mechanical differences in risk between a retail mutual fund and a bespoke PMS.
Walk me through that stress test, because from the outside, it really just looks like a VIP club.
Consider the regulatory constraints placed on a standard retail mutual fund. By law, mutual funds are forced into extreme diversification. A single equity mutual fund might hold positions in 60, 80, or even 150 different companies across multiple sectors.
Right.
Furthermore, SEBI mandates strict concentration limits. A mutual fund generally cannot allocate more than 10% of its total corpus into the stock of a single company.
It's built like a massive cruise ship. If one of the engines fails, the ship doesn't sink. If one company in the portfolio goes bankrupt, the overall impact on the investor's capital is a fraction of a percent.
Yeah.
The shock is absorbed by the other 149 companies.
Exactly. That cruise ship is designed specifically for retail investors who are investing their crucial life savings and cannot mathematically afford a catastrophic loss of principal. Now, contrast that with the architecture of a portfolio management service.
The helicopter.
A PMS is not designed to track the broader market safely. It is designed for aggressive, high-conviction wealth generation. A portfolio manager might build a highly concentrated portfolio consisting of merely 12 to 15 stocks.
That is incredibly concentrated.
It gets more extreme. The manager might identify a massive structural tailwind in a specific subsector, say specialty chemicals. Because they operate a PMS and aren't bound by mutual fund concentration limits, they might take 25% or 30% of your entire portfolio capital and deploy it into a single high-growth mid-cap chemical company.
Wow. Which means if that specific chemical company faces a sudden regulatory ban or a catastrophic factory fire or massive corporate fraud,
If that single high-conviction bet collapses, your overall portfolio takes an immediate, devastating, unmitigated hit. You could lose 30% of your total wealth in a matter of days. The inherent volatility and potential drawdown in a concentrated PMS strategy are magnitudes higher than in a diversified mutual fund.
that's terrifying.
Therefore, SEBI, as the structural engineer, has to ask a brutal question. Who possesses the financial shock absorbers to sustain a 30% or 40% sudden drawdown in a concentrated portfolio without it destroying their livelihood, their retirement, or their family's security?
Only the person who views 50 lakhs as a high-risk allocation, not their entire life savings.
The regulator uses the 50 lakh minimum as a blunt but effective proxy for financial sophistication and risk-bearing capacity. If an investor only has 5 lakhs to their name and they place it into a highly concentrated PMS, a bad macroeconomic cycle will wipe them out completely.
A ruin.
By enforcing that high monetary barrier, SEBI ensures that the individuals participating in these bespoke, high-velocity financial vehicles are financially resilient enough to survive the inevitable turbulence.
So the 50 lakh limit is not a velvet rope keeping the masses out of the VIP lounge. It is a mandatory height requirement for a highly volatile roller coaster. You must be this financially resilient to ride because the G-forces will crush you otherwise.
That analogy captures the regulatory intent perfectly. Now, the workbook does outline highly specific exceptions to this floor.
Oh, there are exceptions.
Yes. For example, the minimum does not apply to a co-investment portfolio manager, which is a specialized structure attached to alternative investment funds. There are also carve-outs for clients who meet the legal definition of an accredited investor, individuals or entities whose net worth or income is so astronomically high that they have proven their sophistication and can negotiate bespoke terms directly.
But for the general public, the 50 lakh floor is absolute.
Yes.
That reframes the entire conversation around risk rather than access. To pivot back to that foundational rule you mentioned, fiduciary capacity. As I said, financial firms love putting that word on their marketing brochures. We are your fiduciaries.
They do.
But rhetoric is cheap. How does the workbook mandate that a portfolio manager actually behaves as a fiduciary in the daily operational grind? What does a fiduciary look like when no one is watching?
Fiduciary duty is the highest legal standard of care recognized in financial law. It mandates an absolute, unyielding obligation to place the client's interests above the firm's interests in every single scenario. And you are correct. SEBI does not allow this to remain a vague philosophical concept.
They codify it.
They translate fiduciary into hard operational firewalls. The most critical is the strict segregation of assets.
Break that down. If I give a manager my 50 lakhs, where does it physically go?
The regulations state explicitly that the portfolio manager must segregate each client's holding in securities in separate accounts. They cannot aggregate the assets of all their clients into one massive corporate mega account.
Okay.
If client A buys shares of Tata Motors, those shares must be held in a specific demat account registered legally to client A. Client B's shares are in client B's account.
Let's run a disaster scenario to see why that matters.
Yeah.
Let's say I'm invested with a boutique PMS firm. It's Friday afternoon. The firm's partners have been secretly making terrible proprietary trades with their own corporate money. They've accrued massive debt, and the firm goes bankrupt. The doors are padlocked.
A classic blow-up.
On Monday morning, the creditors show up to liquidate the firm's assets. Are my shares gone?
Your shares are entirely untouched. Because of this strict segregation mandate, your assets are fundamentally disconnected from the firm's corporate balance sheet.
Really?
Yes, the portfolio manager merely had a power of attorney to execute trades on your behalf. They never actually owned your shares. The creditors can liquidate the firm's office furniture and their corporate bank accounts, but they cannot cross the firewall to touch client A's demat account.
That is a massive structural protection.
Yeah.
What about uninvested cash? Because in any portfolio, there's always a cash drag. You sell a stock on Tuesday, and you don't buy the next one until Thursday. Where is that cash sitting on Wednesday?
The workbook is equally strict regarding cash management. The portfolio manager must keep the funds of all clients in a separate account maintained in a scheduled commercial bank. This creates another absolute firewall.
So they can't touch it.
A firm might be struggling to make payroll for its analysts or struggling to pay its office lease. It doesn't matter. They are legally barred from dipping into the client cash pool for corporate working capital.
I mean, the temptation for a struggling firm to temporarily borrow a few lakhs from a client's idle cash account just to cover rent must be massive. SEBI removes the mechanism entirely.
Exactly. And the prohibitions go even further. A portfolio manager is strictly forbidden from borrowing funds or securities on behalf of the client. They cannot take your blue chip portfolio, pledge it as collateral to a bank, take out a massive loan, and use that leverage to make aggressive bets.
They can't turn my portfolio into a margin account for their own ambitions.
Exactly. Conversely, they cannot lend out the securities currently held in your portfolio to third parties unless it is through highly formalized, SEBI-approved securities lending mechanisms where the risk is clearly documented and the yield flows directly to you.
So no under-the-table lending.
They cannot use your assets as an informal lending library to generate side income for their firm. Every action must adhere to the final pillar of their fiduciary duty. They shall not derive any direct or indirect benefit out of the client's funds or securities other than the explicitly agreed upon management fee.
Which provides a seamless transition into the actual mechanics of execution. Because it's one thing to say you won't steal from the client. It's another thing entirely to navigate the complex plumbing of the stock exchange every single day without accidentally crossing an ethical line.
It's a logistical nightmare.
Let's explore how these managers actually buy and sell. The workbook outlines two primary execution models.
The first, and most operationally complex, is known as pool execution. This is utilized heavily when a manager is executing a uniform strategy across a wide base of discretionary clients.
Give me an example.
Let us say the manager oversees 100 different client accounts, all subscribe to the same large cap growth investment approach. The manager's quantitative model indicates a strong buy signal for Infosys.
Okay, so the manager needs to buy shares for 100 different people.
Instead of the manager sitting at a terminal and manually punching in 100 separate small orders, which would take time, incur massive transaction costs, and result in clients getting wildly different prices as the stock fluctuates throughout the day, they aggregate the total demand.
They groove it up.
They calculate they need 50,000 shares total. They place one massive consolidated block order through their trading terminal into the exchange.
Let's avoid the cliche analogies here and think about this like a massive corporate procurement operation.
I like that.
Imagine a global manufacturing company needs to buy 10,000 tons of steel. The factories in Germany, Japan, and India all need a portion of that steel. Instead of each factory calling the supplier and negotiating different prices at different times of the day, the central procurement office buys the entire 10,000 tons in bulk over the course of the day as the commodity price fluctuates.
Right.
Some tons are bought at $500, some at $510, some at $505. At the end of the day, the central software calculates the exact average cost, say $506, and allocates the steel to the individual factories at that exact blended price.
That is an exceptionally accurate model of how pool execution operates. The portfolio manager's trading desk buys the massive block of shares over the course of the trading session. Once the order is completely filled, the back office systems allocate the shares to the 100 individual client demand accounts on a strict pro rata basis.
But wait, I see a massive potential for fraud here if SEBI wasn't watching. Let's run a fraud scenario.
Let's do it.
The manager buys the 50,000 shares in 3 tranches throughout the day. The morning tranche is bought cheap at RS 1000. The midday tranche is RS 1050. The afternoon tranche is bought at RS 100 because the market rallied. If I am a corrupt manager, what stops me from allocating the cheap RS 1000 shares to my favorite highest-paying client, or worse, to the firm's own proprietary trading account and dumping the expensive RS 100 shares onto a client I don't care about?
You have described the exact mechanism of cherry picking, a historical form of market abuse. And this is precisely why SEBI enforces the weighted average rule. The regulations explicitly mandate that the inter-C allocation, the distribution of shares from the pool back to the clients, must be done at the exact weighted average price of the day's total transactions. The manager has zero discretion in assigning specific prices to specific clients.
They can't pick and choose.
Everyone in the pool, regardless of their net worth or relationship with the firm, receives the exact same blended execution price.
The software forces equity.
Furthermore, to prevent managers from using the pool account as a speculative holding pen, the regulations state that the portfolio manager shall not keep any open position in respect of allocation.
Meaning?
When the market closes at 3:30 p.m., the pool account must be emptied. Every single share bought must be allocated to a client's demat account by the end of the day. The manager cannot buy 50,000 shares, allocate 40,000, and hold 10,000 in suspense overnight, hoping the price goes up tomorrow so they can skim a profit.
The procurement warehouse must be empty by midnight. Now, the alternative to pool execution is trading directly in the individual client's name, which I assume is simpler but perhaps less efficient for the manager.
Yes, it involves the trading systems generating individual orders for each client directly into the exchange. The allocation is immediate upon execution, but the transaction costs and potential for price disparity between clients are higher.
So we understand the mechanisms of how they execute. Now we must confront the don'ts, the absolute guardrails, because a portfolio manager has massive discretionary power, but they cannot simply wake up and decide to put client capital into an unlisted crypto startup. They are bound by the investment approach.
The investment approach is the constitutional document of the client-manager relationship. It is an extensive, documented outline of the permissible universe of securities, the risk parameters, and the overarching strategy.
It's the sandbox.
It is signed and agreed upon before a single rupee changes hands. If the investment approach dictates a universe of top 100 NSE-listed companies, the manager is legally barred from exploring small-cap mining stocks or unlisted private equity. It defines the boundaries of the sandbox.
And to ensure the manager doesn't try to dig under the walls of that sandbox, the workbook lists a series of explicit prohibitions. Let's go through these strict don'ts, because reading them feels like reading a history of financial crimes.
They are deeply revealing of past systemic vulnerabilities. Let us start with the first major prohibition. The portfolio manager shall not invest clients' funds based on the advice of any other entity.
I want to deduce the reasoning here. If I'm paying a portfolio manager a 2% management fee on 10 crores, I am paying for their proprietary genius. I'm paying for their team of analysts visiting factories and crunching balance sheets.
You're paying for alpha.
Exactly. If they just secretly subscribe to a boutique research report and blindly copy the trades, or if they just mimic the portfolio of a famous mutual fund manager, they're essentially defrauding me. They are charging a premium for outsourced labor.
Your deduction is flawless. The regulation demands the creation of original intellectual property. The manager must generate their own thesis, their own risk models, and their own conviction. They cannot operate as a highly paid copycat.
What is the next major prohibition?
This one addresses a very specific conflict of interest regarding fee structures. The portfolio manager, while investing in units of mutual funds through direct plans, shall not charge any kind of distribution-related fees to the client.
We need to explain the mechanics of mutual fund commissions here to make sense of this. For the listener who might not know, every mutual fund in India generally has two versions: a regular plan and a direct plan.
Right.
The regular plan has a hidden commission built into the expense ratio. The AMC takes a piece of your investment every year and pays it as a kickback to the broker or bank who sold you the fund. The direct plan cuts out the middleman. You buy directly from the AMC, there is zero commission, and your returns are mathematically higher.
A concise summary of the distribution architecture. Now, imagine a portfolio manager decides that the best way to gain exposure to international equities for your portfolio is not to pick individual foreign stocks, but to allocate a portion of your capital into an international mutual fund.
Under their fiduciary duty, they are legally obligated to buy the cheaper direct plan for my portfolio.
Yes. But historically, unscrupulous portfolio managers sought a loophole. They would buy the commission-free direct plan for the client, honoring the letter of the law, but then they would invent a distribution fee or an advisory surcharge and bill the client internally for it, essentially replicating the hidden commission and pocketing it themselves.
They recreated the kickback out of thin air.
SEBI's prohibition explicitly outlaws this double-dipping. The logic is impenetrable. The client is already paying a comprehensive management fee on their entire AUM. The manager cannot sneak in secondary distribution fees on products designed to be commission-free. The fee structure must remain entirely transparent.
Let's move to a prohibition that sounds like it belongs in a financial history museum, but is clearly still relevant. The text states, "The portfolio manager shall not deploy the client's funds in bill discounting, bad law financing, or for the purpose of lending or placement with corporate or non-corporate bodies." I have to stop at bad law financing.
I thought you might.
That sounds like a plot device from a 1990s stock market thriller. What exactly is the mechanic of bad law?
Bad law is a fascinating, archaic mechanism that dominated the Indian stock exchanges prior to the introduction of modern, formalized derivatives like futures and options. It was essentially an indigenous carry-forward system.
Walk me through how it actually worked on the floor of the exchange.
Let us say a speculator wanted to buy 1,000 shares of a company, anticipating a price rise. But the speculator did not have the cash to actually pay for the shares, and they did not want to take physical delivery of the certificates.
Wait, so they didn't even have the cash, they just wanted to ride the price movement.
Exactly. Under the bad law system, the speculator could essentially carry forward the transaction to the next settlement cycle. But to do this, they needed someone to finance the trade. They needed someone to pay the seller for the shares and hold them temporarily.
A middleman.
This financier, the bad law financier, would provide the capital at highly variable, often exorbitant interest rates, which were determined by the demand for leverage on the exchange floor that day.
It was a massive, decentralized shadow lending operation built directly into the plumbing of the stock market.
It was incredibly risky and prone to causing systemic contagion. If the market crashed, the speculators couldn't pay the financiers went bankrupt, and the entire settlement system of the exchange ground to a halt. And bill discounting. Bill discounting is a corporate finance practice where a business, desperately needing short-term cash flow, sells its unpaid invoices, its accounts receivable, to a third-party financier at a discount. The financier gives them cash today and collects the full amount of the invoice from the end customer later.
So, connecting these historical practices to our modern rules, SEBI is looking at portfolio managers who are sitting on pools of client cash. And SEBI is drawing a massive red line.
A very thick red line.
They're saying, you are an investment manager. You are not a bank. You are not a shadow lender. You absolutely cannot take the client's idle cash and use it to finance the highly leveraged bets of day traders in a carry-forward market. Nor can you act as a short-term loan shark providing working capital to struggling corporations.
The prohibition forces the capital to remain in legitimate capital market instruments. It prevents the manager from utilizing client funds to earn high-interest yields in the opaque, unregulated shadow banking sector where the risk of catastrophic default is immense.
There is another prohibition here regarding leverage. The manager shall not leverage the portfolio of its clients for investment in derivatives.
The mechanism of derivatives futures and options allows an investor to control a massive amount of an underlying asset with a very small initial margin. It is inherent leverage.
Right. I can put down 1 lakh and control 10 lakhs worth of stock. If the stock goes up 10%, I double my money. If it goes down 10%, I'm wiped out entirely.
The regulation acknowledges that derivatives are valid instruments, but heavily restricts their application. A portfolio manager can utilize derivatives to hedge risk, for instance, buying put options to protect a portfolio during a market crash.
As an insurance policy.
Right. But they are strictly prohibited from borrowing external capital or using the client's portfolio as collateral to take massive, highly leveraged, speculative bets on the direction of the market. The client's downside must always be mathematically capped by the actual capital they deployed, not magnified by borrowed money.
Looking at this entire list of don'ts, the ban on double-dipping commissions, the ban on shadow lending via BADLA or bill discounting, the strict ban on leveraged derivatives, these aren't just arbitrary theoretical scenarios dreamed up by lawyers in a boardroom.
Far from it. When you analyze financial regulation, particularly in a market with as vibrant a history as India's, you realize that every single one of these prohibitions is regulatory scar tissue.
They're written in blood.
Metaphorically, yes. Each rule represents a historical vulnerability, a past market scandal, or a systemic failure where a manager exploited a mechanism. They gambled with client money in the shadow markets, they secretly extracted hidden fees, or they blew up portfolios with unchecked leverage. SEBI has spent decades systematically closing these loopholes. The workbook is a living document of historical mistakes that the regulator is determined will never be repeated at the expense of an investor.
It brings a heavy reality to the text. It's a defensive fortress built from the wreckage of past crashes. Let's move to the next phase of the investor journey. We've covered the entry, the strategies, and the operational guardrails. Let's discuss the exit. Section 5 in our outline deals with breaking up with your portfolio manager.
The inevitable end of some relationships.
Exactly. What happens if the bespoke strategy isn't working? What if the manager is adhering to all the rules, but the returns are terrible? How difficult is it for the client to retrieve their 50 lakhs?
The regulatory framework is remarkably definitive regarding the investor's ultimate sovereignty over their capital. The text states unequivocally that portfolio managers absolutely cannot impose a lock-in period on the investment of their clients.
No lock-ins, meaning I don't have to sign a contract saying my money is trapped for 3 years.
Zero lock-ins. The client possesses the absolute right to demand the premature withdrawal of their funds or the transfer of their securities at any given moment. The control over the capital always resides ultimately with the investor.
Okay, total freedom. That sounds incredibly pro-investor. But in the architecture of finance, there is rarely freedom without friction. If there is no lock-in, what is the mechanism to prevent chaos?
The friction takes the form of a standardized, heavily regulated exit load structure.
A fee for leaving the party early.
Precisely. The regulator understands that while the investor must have liquidity, the portfolio manager must have stability to execute their strategy. Therefore, SEBI mandates a maximum permissible exit load cap.
What are the numbers?
If a client redeems their portfolio in part or in full, the manager can charge an exit load as follows. In the first year of the investment, the penalty is capped at a maximum of 3% of the amount redeemed. In the second year, the cap drops to a maximum of 2%. In the third year, it drops further to a maximum of 1%. And critically, after a period of 3 years from the date of investment, the exit load drops to absolute zero.
I have to pause and look at the math here because the tension is palpable. The regulator champions my right to liquidity, but the penalty for exercising that right is severe. If I invest 1 crore into a PMS, and 6 months later I decide the manager's communication style is terrible and I want my money back, a 3% exit load means the manager deducts 3 lakh rupees just for letting me leave.
Yes.
That is a massive financial hit. If SEBI hates lock-ins, why do they permit such a punitive exit fee in year 1? It feels contradictory.
It is a brilliant question that cuts to the core of market mechanics and ecosystem protection. To understand the exit load, we must look beyond the individual investor leaving and look at the investors who are staying. We must understand the structural vulnerability of illiquid strategies.
Walk me through the mechanics of that vulnerability.
Let us revisit the boutique portfolio manager whose specific, documented investment approach is to identify deeply undervalued, illiquid small-cap manufacturing companies. These are obscure stocks. They trade in very low volumes on the exchange.
Right, there aren't many buyers and sellers on a given day.
Buying a significant position takes weeks of careful accumulation to avoid driving the price up, and selling a significant position takes weeks of careful distribution to avoid crashing the price.
It's a strategy that requires immense patience.
Now, imagine a high net worth client allocates 20 crores into this specific strategy. The manager painstakingly deploys that capital over several months, acquiring these illiquid shares. The portfolio is set for a planned 5-year growth cycle, but 4 months later, the client suffers a liquidity crisis in their personal business, or they simply panic over a macroeconomic headline, and they demand their 20 crores back immediately.
Because there's no lock-in, the manager is legally obligated to return the capital.
The manager must comply. But to generate 20 crores in cash immediately, the manager is forced to dump massive blocks of highly illiquid small-cap stocks onto the open market on a single Tuesday afternoon. There simply isn't enough buyer demand to absorb that volume. The manager has to sell at a severe discount, single-handedly crashing the market price of those specific companies.
The client leaving takes a massive loss on the execution.
The departing client takes a loss, yes. But the systemic tragedy is that the manager holds those exact same small-cap stocks in the portfolios of all the other clients who are invested in that strategy. The sudden, panicked withdrawal of one massive client acts as a wrecking ball, destroying the valuation and disrupting the meticulously planned multi-year strategy for every single patient investor who remained in the fund.
So the 3% exit load isn't designed as a profit center for the manager to get rich off unhappy clients. It's a protective barrier for the ecosystem of the strategy itself.
Exactly. The declining 3-2-1-0 exit load scale acts as an intentional friction mechanism. It fundamentally aligns the investor's time horizon with the realities of market liquidity. It telegraphs a clear message to the prospective client. You have the absolute right to leave at any moment, but if your sudden departure forces the manager into disruptive emergency liquidations that harm the remaining investors, you will pay a significant financial penalty. It forces the investor to pause and consider if their capital is truly patient.
It effectively filters out the tourists. If you want day-to-day liquidity where you can enter and exit the market on a whim without penalty, you belong in a highly liquid large-cap mutual fund or an ETF. But if you want to participate in specialized, potentially illiquid wealth generation, you must commit to being a resident for at least 3 years.
It creates an alignment of incentives that allows the portfolio manager to actually focus on long-term value creation, rather than constantly managing the portfolio defensively against the threat of sudden capital flight.
Okay, we are entering the final critical segment of our deep dive. We've explored the entry, the rules, and the exit. But a system is only as strong as its enforcement.
Very true.
With enormous sums of money moving through bespoke strategies, no lock-ins, and complex execution mechanics, who is actually watching the watchers? How does a client know the entire operation isn't a sophisticated facade?
The Indian regulatory architecture does not rely on trust. It relies on a dense, interlocking web of independent entities, relentless documentation, and aggressive reporting mandates. The most critical component of this structural safety net is the role of the custodian.
The custodian. I saw this in the text and I want to highlight it because it completely changes the risk profile of the investment.
The workbook mandates that every portfolio manager, with the sole exception of those providing pure advisory services where they never touch the money, absolutely must appoint a custodian in respect of the securities managed or administered by it.
The critical realization here is that the portfolio manager, despite their title, doesn't actually hold the client's shares in their own corporate name. The custodian holds them.
This separation addresses the ultimate nightmare scenario that haunts every wealthy investor: counterparty risk.
The Bernie Madoff scenario.
Exactly. What happens if the brilliant portfolio manager is actually running a Ponzi scheme? What if the executives falsify the internal accounting, the firm goes bankrupt overnight, and the partners attempt to flee the jurisdiction? Where are the actual physical assets?
If the manager held the assets directly in their own vaults, the money would be gone before the regulators even woke up.
Precisely. But the SEBI ecosystem structurally severs the decision maker from the vault. The portfolio management firm is merely the brain. They analyze the market and transmit the decisions to buy and sell. But the custodian, which is typically a massive, heavily regulated multinational bank or a highly specialized depository institution with billions in capital reserves, acts as the impenetrable vault.
So they hold the keys.
The custodian physically and electronically holds your uninvested cash and your demat shares.
So the manager has the authority to dictate trades, but they lack the physical capability to steal the underlying assets.
If the portfolio management firm ceases to exist in a cloud of scandal on a Friday, your assets are perfectly safe. They are sitting quietly in your name, securely locked within the infrastructure of the custodian. The structural separation neutralizes the existential risk of corporate fraud.
That is incredibly reassuring. It's like hiring a brilliant interior designer for your mansion. They have the authority to move the furniture around, change the drapes, and repaint the walls to increase the value of the home, but they don't hold the title deed to the house. And they certainly don't have the password to wire the house's equity to an offshore account.
That is a highly effective way to conceptualize the relationship. But securing the physical assets is only half the battle. The regulator must also monitor the intellectual integrity of the manager's decisions. And that brings us to the staggering record-keeping requirements.
What exactly does a PMS firm have to document?
The standard corporate requirements apply. They must maintain a copy of the balance sheet at the end of each accounting period, a copy of the profit and loss account, a copy of the independent auditor's report, and a statement of financial position. All of this must be preserved immaculately for a minimum of 5 years.
That's standard accounting for any major corporation. But there's a specific clause in the text regarding the trades themselves that caught my eye.
Yes, the true hallmark of fiduciary enforcement. The regulations demand that the portfolio manager must maintain records in support of every investment transaction or recommendation, which will indicate the data, facts, and opinion leading to the investment decision.
Data, facts, and opinion leading to the decision. I want the listener to really internalize the weight of that requirement. It is an incredibly heavy burden of proof.
It creates the ultimate, unassailable audit trail. Contrast this with retail investing. An individual investor might log into their brokerage app and buy 500 shares of an electric vehicle company purely because they read an exciting headline, or because they saw a trend on social media, or they just had a gut feeling about the future.
I think we've all been guilty of the gut feeling trade.
But an institutional portfolio manager is legally forbidden from operating on intuition. It is simply not enough for their trade to turn out profitable. If a manager allocates 5 crores of client capital into a mid-cap pharmaceutical stock on a Tuesday morning, they must possess a written, time-stamped, highly detailed file proving exactly why that decision was rational at that exact moment.
They have to document the quantitative analysis. What was the price-to-earnings ratio? What were the projected cash flows? What macroeconomic shift dictated the entry point?
Exactly. If SEBI conducts a surprise audit 2 years later and demands to know why the manager deployed client capital into a stock that eventually went bankrupt, the manager cannot shrug and say, the chart looked bullish at the time. They must produce the internal thesis, the analyst reports, and the specific data points that justify the risk. It ensures the entire investment process is methodical, rigorous, and entirely devoid of emotional speculation.
So we have the custodian acting as the vault, and we have the audit trail forcing rational behavior. But who is policing this inside the building on a daily basis? SEBI can't have an inspector sitting in every portfolio manager's office.
That internal policing role falls to a mandatory appointment, the compliance officer.
Every firm has a compliance department, but this workbook gives them a very specific mandate.
Their mandate is uniquely powerful and deliberately insulates them from corporate pressure. The regulations state that the compliance officer shall be responsible for monitoring the compliance of the SEBI Act, rules, and regulations. But the critical mechanism is in the reporting structure. The text explicitly demands that the compliance officer shall immediately and independently report to SEBI any non-compliance observed.
The word independently is doing a massive amount of heavy lifting there.
It changes the entire power dynamic within the firm. If the CEO or the lead portfolio manager of the firm demands that the compliance officer ignore a minor breach of the investment approach to secure a higher return, the compliance officer is legally obligated by SEBI to bypass the executive board entirely and report the breach directly to the regulator.
Their ultimate legal loyalty is to SEBI and the integrity of the capital markets, not to the executives who sign their annual bonus check. It's essentially a legally mandated internal whistleblower system designed to prevent systemic cover-ups.
It forces transparency from within. And finally, what happens when the system fails the client? What if an investor believes their portfolio was mismanaged or the exit load was calculated incorrectly? What is the recourse?
Because wealthy clients don't want to spend 10 years tied up in the civil court system.
And SEBI does not want them to. The rules impose a highly aggressive timeline for grievance redressal. The portfolio manager is mandated to take adequate steps to resolve any investor complaint within 21 calendar days of receipt. Furthermore, they cannot sweep complaints under the rug. They must keep SEBI continuously informed about the volume, nature, and resolution status of all grievances.
21 days is an incredibly tight window for complex financial disputes. What happens on day 22?
SEBI has recently modernized the entire escalation process by introducing a mandatory online dispute resolution mechanism, or ODR. If a portfolio manager fails to resolve the grievance to the client's satisfaction within the 21-day window, the client can immediately escalate the issue into the ODR portal.
Oh, wow.
The system automatically routes the dispute to independent mediation or binding arbitration overseen by approved market infrastructure institutions.
It takes the power of delay away from the firm.
The days of a financial institution simply ignoring an angry client's emails or burying them in endless internal reviews are entirely over. The regulatory web is dense, highly interconnected, and relentlessly focused on providing rapid, transparent resolution for the protection of investor capital.
The architecture we have unpacked today is staggering. We have journeyed through the entirety of Chapter 7, dissecting the true role of portfolio managers. We began by establishing their identity not as rogue traders, but as heavily capitalized, highly scrutinized body corporates. We explored the historical urgency of 1993, understanding how securing the bespoke capital at the top was the necessary foundation for building a trustworthy market for the entire country.
We examined the operational models. The highly efficient discretionary model, the psychologically demanding non-discretionary structure with its inherent execution lag, and the purely intellectual advisory model.
We tackled the 50 lakh entry barrier, reframing it from an elitist velvet rope into a structural necessity. A seatbelt required to survive the high G it truly is. And to you, the listener, whether you are currently managing a business exit and have 50 lakhs ready to deploy into one of these bespoke vehicles tomorrow, or whether you're earlier in your journey, methodically building your wealth through disciplined mutual fund investments, understanding these elite, high-tier regulatory mechanics is invaluable. Knowing exactly how the biggest pools of capital are legally forced to operate gives you a lens to identify true professionalism. It makes you a sharper, more demanding, and more resilient investor in any market environment.
But as we conclude this exploration of institutional rigor, I want to pivot the focus back to you, the listener, and the daily decisions you make with your own capital. We discussed the staggering record-keeping requirements imposed on these elite portfolio managers, the unyielding mandate to maintain an auditable written record of the exact data, facts, and quantitative opinion behind every single trade they execute. The regulator demands this absolute standard of proof to banish emotional decision-making from the process. So my challenge to you is this. Are you applying that same rigorous standard of proof to the investments you are making in your own personal portfolio today? Or are you still just relying on a gut feeling and a broken X-ray machine?